Hey everybody, Eric Hale with another episode of The Everyday Trader. And with me today is my beautiful co-host,
Beautiful. I love it.
Vanna White.
Vanna White. I am actually feeling very pale. It's that time of year when I need to get outside. But yeah, it's good to be with you.
Yeah, good to be with you too. So a couple of things. First of all, you guys, ladies and gentlemen, appreciate all of your support and feedback. Our number one by far video was the one we did last week talking about GLP-1 inhibitors. And some people have asked us to actually they asked us to bring Barry back. I got a few people. Remember, we had Barry, who's this Mr. Semi from who has insight on semiconductors. So we need to get him back. But next week we do have a special episode. We're going to bring in a guest, Charan Singh, who's an instructor with Options Animal and also a money manager. So he manages private capital, and is going to share some of his insight and experience, and got some other ones lined up too. Yeah.
I actually had a conversation with Barry. I did a daily market update over at Options Animal last week, and I talked about NVIDIA and how I felt NVIDIA was expensive, and how there's other areas of growth right now in the semi space that maybe aren't as expensive. And I had a good conversation with him after the fact. He actually had just gotten back from fishing that day, been down in the Keys bone fishing, and
Really?
hopped on my daily market update, and then we chatted back and forth afterwards for a little while about just because Nvidia is expensive right now and it might not be a great time to buy it does not mean you should be selling it either, because the internet bubble lasted for a long time before it popped, and I think the AI bubble could still get inflated for a while before it actually pops. So there's a lot of positive momentum still in this space.
Well,
But anyway,
I'll take the other side of that just to be point and counterpoint. If you look at the price to earnings growth divided, so price to earnings divided by growth, the PEG ratio, which is if you look at overall the market, the S&P 500, the S&P 400, the remaining 493. You look at the Magnificent Seven, of course, which is Nvidia and Apple, Google, Microsoft, Meta, Tesla. It's not overvalued by this metric. So one could argue, but to stick with what Barry suggested, I think he was saying is kind of be in the shovel business during a gold mine. And companies like, if you take a look at what happened with Meta, not Meta, I'm sorry, Micron and some of the other companies. One that I talked to, let me just share the chart here on Micron. Uh, Micron made some new announcements about new technology, but this has been a nice, steady growing trend. And every single NVIDIA chip that gets sold, there's a piece of Micron on there someplace, 90% of the time. So going with some of these, as he said, the lagging edge companies, and another one that he talked about was Texas Instruments.
yep.
But just an article that I was reading yesterday, and I was really slow to the punch, but I read a very bullish article on good old Michael Dell's Dell Computer. Um, Huge move today, great earnings. All of these computers that are being installed someplace are these NVIDIA chips. They're going in pizza boxes, rack servers someplace, and a good portion of them are Dell and HP and other companies as well. I was going to show one other thing that I tweeted out here with on it. Speaking about this is NVIDIA's share of data center compute. Now, data centers have been growing insane. But if you look at the dark blue line, this is the market share that NVIDIA has, which is just insane. And Intel, which is basically a dog. I've been bearish on Intel. And then you've got AMD here, which is doing okay. That the small I mean, I think their AMD's numbers are actually growing, but because this is 100% of all of the server market, the overall server market is growing incredibly. But this AI thing is real, folks. This is going to go down in history like the invention of the loom or the cotton gin, and during those periods of time, or the invention of the automobile, or Henry Ford's the assembly line. These are it is a step change in economic performance. What is happening with AI? It has completely transformed everything that I do. We did a bit on using ChatGPT. I use ChatGPT 5 times a day, at
Yeah.
least 5 times a day.
No, I agree. And so
I,
let me ask you a question, because I want to come back to, I'm going to bring back kind of some of the comments I was having in the daily market update. If you look back to the internet bubble, because this is arguably AI is the biggest change in the economy, what's going to drive since the internet 20 some years ago. Who is the biggest winner from the internet? If you look back now, if you look at today's stock prices and you had to pick a company, who's the biggest winner?
I want to say Google or Microsoft.
Maybe Microsoft, maybe Google, maybe Amazon is another one.
Amazon for sure. Yep. Not pets.com.
Do you know
Not
who it was?
JDS Uniphase.
Cisco.
Cisco.
And my comparison is NVIDIA is similar to Cisco right now, in that NVIDIA builds something that is hardware related, that eventually we will reach capacity. Eventually, all those data centers that you just pointed out, they will have upgraded all their chips. They haven't yet. And so NVIDIA's growth is insane right now, but it will eventually become commoditized. Their competition will come in eventually. And and Cisco back in the 90s, when everything had to be connected with all of Cisco's chips, or sorry, not chips, all of Cisco's routers to connect the internet. Cisco was the player. And it has been dead money for 25 years since its meteoric rise through the 90s.
Yeah.
Because they were blowing up. I think that's what NVIDIA's future is, personally. I think the winners in AI, some of them may not even exist yet. But I think it's going to be more on the software side, and people who figure out how to monetize AI, not in a way that's strictly hardware in nature, because ultimately that's what NVIDIA is. It's a hardware play. And I still think there's growth there, but I don't think it's infinite growth like is being priced into the stock right now.
Greg, I gotta be clear. My excitement about AI is just in the overall impact economically. Yeah. I mean, I'm talking about the impact to GDP. I mean, we're talking serious dollars. And keep seeing these reports on the number of times that AI is mentioned on shareholder calls. And we just finished up earnings, and I think 87% of all companies mentioned AI. It's like obviously a quarterly high. I mean, it's an all-time high. And there's not a company that isn't looking at the benefits. And my wife's an HR manager, and she's using it too. And they're a healthcare tech company, and they're looking at, making major transformations. And it's really interesting what's going to happen to the economy. And it's easy for people to go to the negative side and think, oh my gosh, I'm a cotton picker. I'm not going to be. Eli Whitney invented this cotton gin. And I think it was Fisher from the Dallas Fed who did a speech that really resonated with me, and talked about, at the time he was talking about innovations elsewhere in automation and things like that. But people freaked out when the cotton gin was invented, because we're going to put all kinds of people out of work and it's going to affect the economy. And I mean, yeah, some people lost their jobs. By and large, we're way better off. A cotton gin could do the same work as 50 people in the same amount of time and do a better quality job. So you put 50 people out of work. And, at the time it was hard, but the same thing is going to happen with AI. I mean, we're going to put hundreds of thousands of people out of jobs, but, social media manager, search engine optimization, 10 years ago, we didn't even know what those jobs meant 10 years ago. So we're going to have new jobs. I think we do need to worry about people economically, and maybe there's some argument for a safety net. But I think there's going to be tremendous change overall in the economy, and there's ways to play it.
Yeah,
I'm out of NVIDIA myself, but maybe I should get back in. I don't know.
I think you can let this say. I mean, I don't know. Maybe there's a safety net need, maybe not. I think the private market will create those new jobs that you just said didn't exist 10 years ago. I think new jobs will pop up. I agree with you 100% on the innovation that will come if we let capitalism work, it will innovate and create new jobs and create new growth. And I'm 100% on board with you that this AI ride is still going. I believe there will be a market bubble related to it still, just like there was with the internet. I don't know that we've even blown it all the way up yet, to be honest. I think there's still upside with this bubble. If you actually posted something, I don't remember where you posted it, about March being a bad time. I don't know if that was on Twitter or where you shared that somewhere, March being a bad month for the markets. But the one that stood out to me was March 2001. Sell-off in the US stock market after Fed fails to cut rates. Are we there?
Let's pivot to that. Let's talk about the Fed. So we did get a PCE number that came in today, or yesterday, I'm sorry. And if we look at PCE overall, this is the Fed's preferred measure for inflation. And it does look like we've got a trajectory heading down towards 2. And the Fed has said that they are going to cut rates before we get to 2. So what did this do to the sentiment on this? I like to use this website. This is the CME Group's looks at Fed futures, and look how the price of Fed futures changed. It's to me, it's more about the change than the absolute numbers. And these are the numbers today. So the odds of a rate cut. So let's look at March. So we're at 95% chance that we're going to stay where we're at. Our current rate is in this 525 to 550 range. So no real change. But if we go out to like July, we can see that since yesterday, today, there's a shift. The odds of us staying here are 8%. And I think the market's got this wrong. I was on record, 6 months ago saying if we cut rates in March, I'll eat a shoe. And I think there's a pretty good chance I'm not going to eat a shoe. I'm not going to make that same bet. But I'm looking at the rest of this year, and I'd like to get your thoughts overall. The PCE came in right in line with everything. And is it enough that's compelling to make the Fed start cutting rates now? What are your thoughts there?
I've heard some commentary on both sides. The one argument of arguing for an earlier rate cut is that the Fed doesn't want to wait, or this is, again, this is their theory. I'm saying the people they're saying they need to start cutting soon, is that they need to be in accommodative mode before the economy needs it. And that if they wait to cut rates, if they wait too long and don't do it until the economy shows signs of weakness, then we're actually in trouble, that they've waited too long. And is that the case right now? I don't know. I'm actually on the other side of the coin. I've read several pieces this morning talking about actually the strength of the economy, and that not only are we having record S&P earnings again, we just got to the end of this quarter.
Yeah, absolutely.
Record earnings. We have growth, not just from the Magnificent Seven, although they are the powerhouse still of the S&P earnings. They're not all of it. A lot of growth, a lot of growth is coming from these ideas. Like one idea that's not talked a lot about, and I'm stealing some of this from a newsletter that I've read, and I'm not going to talk about which one it is particularly, but this idea of re-regionalization, and that there's a lot of construction going on and demand in the construction industry for maybe let's call it a deglobalization. There's another word: re-regionalization, deglobalization. Countries pulling back in and building here locally, and it's creating demand, and it's a real lasting demand that's driving jobs. The job market is strong. Earnings are strong. So for me, I'm almost leaning that this year, I'd almost think there's a higher chance of a rate hike rather than a rate cut. because of the strength of the market. Now, we're in an election year too, so that throws a whole nother wrench in it. But I think the Fed's going to sit on their hands. If you had to ask me right now, what's the Fed going to do this year? I'm going to say the first rate cut we might get would be December.
Well, yeah, so you started going down that other path, and maybe we'll loop back to that. But as far as the odds of the rate, I think the market has it wrong. And looking at these, oh, that's the scared shared the wrong screen there. Here's the screen I meant. Yeah, there. So this is the CME group looking at the Fed fund futures, or you can also look at the SOFR rates. And you and I were talking before we hit the record, I think, and I think there's some weakness in using these data to prognosticate what the market thinks, because people are buying an asset which could be a protective asset. It's different from people betting on something, betting on an outcome. It's cheap insurance for someone to, if they've got something tied to rates, they can buy insurance on where the Fed will be, and it's cheap. So these are very fairly illiquid markets, and they can be moved pretty quickly. And if you look at the surface of this data, I would agree that the market's perception of a rate cut in July has gone up. But I think you really need to step back and look at the bigger picture and what's going on here. First of all, nobody's talking about how great jobs are. And we didn't get jobs today, first Friday, but it's was the first Friday after the first Tuesday or whatever.
Yeah.
Yeah. So next Friday is the jobs report. You heard Waller say it. Tremendous air cover. We've never gone into a recession with unemployment being under 6%. I know there's different economists that take different points, but we can afford to let some bad stuff happen in the economy. GDP is coming in incredibly strong. If you look at the latest GDP numbers, very strong.
Hey, I got to interrupt you for a minute. We haven't talked about Waller, your conversation with Waller yet.
We shouldn't talk about it here.
We shouldn't talk about it
while
we're
recording. Definitely Chatham House's rules. So
all right. I
spent hours with him one-on-one.
Yeah.
And his wife Lori, who's she's a personal trainer. I mean, we just hit it off. She's like, he's an awesome guy. And by the way, this I can probably share because it was in the Journal. I don't know if you saw Nick Timros's piece this week. Did you see that?
I didn't actually.
WSJ. This is you probably need to read this.
The Fed governor who proved Larry Summers wrong.
Yeah. So by Nick Timros. And I actually had a conversation with Bill Kennedy, CIO at RiskBridge.
Right.
About this. I thought it was a great article, but the question is, why am I reading this now? And that's a Ben Hunt sort of epsilon theory.
Yeah.
Why am I reading this now? Which brings in a lot of questions. I was like, Chris, who you think the next Fed chairman would be? He goes, I think it's going to be me.
It very well could be. Let's be honest. Trump loves him. If Trump wins and appoints the next Fed chair, and honestly,
first of all, that's his wife right there, and that is a terrible picture. Anybody knows what RBF stands for? Because she's very. I'm looking at the picture. I'm like, right in the middle. Who's that lady? And she looks really angry. That's his wife. That's Lori Waller. So we have kids of the same age. We have your kids, my kids. We're both about the same age. Our kids are the same age. Waller and I hit it off pretty good. I'm saying this because he is a regular freaking guy. And if you believe in people out there love to bash on the Fed, you're full of crap. You don't know what you're talking about. I mean, it's fun to bash on the Fed. This guy, I gave him a free market capitalist card.
Did you?
Yes. Nice. When I went to the Berkshire Hathaway meeting, I got one for him, and I said, because he told me, I said, are you a capitalist? I'm a card carrying capitalist, he said. So now he literally is a card carrying capitalist. I don't know. I have mine here.
I don't know where mine is. You got me one once too.
Yeah. You see, you're kicked out of the club, Greg. You can't.
Maybe it's actually in my wallet.
It might be in your wallet.
I mean, it should be, right?
Around with me somewhere. I might have gave him the one I had in my briefcase. Anyways,
Mine's in my desk at my home. That's where
listen, the guy's a free market capitalist. He's done a great job. He's nailed what's happened with the economy. They're watching jobs very high. Inflation is what happened today with PCE, with this week in PCE, is not an overwhelming signal that we should be cutting rates. But here's the bigger picture, and this goes to the political aspect of this. Okay, I'm do not think we're going to see the Fed being overtly political. I actually think what we're going to see is them doing the opposite.
yeah.
I do not think they want to give any signal that they're helping either party. And ladies and gentlemen, we have tons of air cover for them to do nothing until we start seeing bad stuff in the economy. If we see major changes in the inflation data, we're not seeing it. Major drops in GDP, we're not seeing it. If we see unemployment getting really, really bad, we're not seeing it. They have air cover for the next year. And then if you look at the calendar of the Fed meetings, July 24th, it's 2 weeks after the GOP convention. It's 2 weeks before the Democratic convention. If they make any changes around that, they're going to get slaughtered. So the next meeting after that is in September. What are the odds that they do something then? Right before the election.
Yeah, a
If
month
they
before
do
the election,
anything, they're
no
going to get
way.
slaughtered. They're
Yeah.
going to be hung up to dry. You're favoring whatever they do, raise or cut. One party's going to November 7th, 2 days. What is that? Like 2 days after the election? Maybe. I don't think we're going to see any rate cuts this year. December at the earliest is where I would put my money.
That's me too. I'm in the exact same place, and partially because of political. I agree with you on that, but I think mostly because we don't need it. There is no reason to cut rates right now. The economy is as strong as it's been in a long, long time. There's still an enormous amount of liquidity out there. Jobs are plentiful. And yeah, I agree with you. Unless we see some major piece of economic data on the jobs front, on the GDP front, on earnings starting to be soften, we see some bank failures, whatever it might be, like not just, not to mention that a year ago, those bank failures were big bank failures, but we survived it. It didn't really cause a major ripple in the economy and in the financial system. So unless we see something break, I don't see the Fed cutting rates. They don't need to. We're growing in spite of high, 5.25%, 5.5% Fed funds rate right now. The economy's still strong. Why cut?
I maybe we spent too much time together. I wish I could
Maybe.
argue. I
I
wish
know.
I could argue it. I wish I can't poke holes in your argument. It totally makes sense to me. So I'm willing to be wrong, but why do we need rate cuts too? We're at all-time highs in the market, so
Yep.
enjoy it. I think there's good stuff going on there.
We got Bitcoin at all-time highs. We got gold at all-time highs.
I know, isn't it wonderful?
I mean, everybody's making money. Savers are making money. You can go get a
All-time savings.
Yeah,
The
you can get a
savings rate
five.
went up again today, right? Or
Yep.
this with a PCE report.
Everybody's making money.
Yeah. So I think it's a good week. I think there's lots of opportunity. Oh, one other big one. Oh, we didn't talk about this ahead of time. You see, Apple got downgraded.
At Goldman.
Yeah.
Goldman. Yeah.
They were on the conviction buy list. Okay. This is Goldman Sachs top 25. Top 25. And they got cut from there. They got cut from buy to hold.
Do you think that's in reaction to Berkshire's 13F and that Berkshire actually started selling some Apple shares?
Yeah, Berkshire sold 10 million shares.
Do you think
My thought is that they needed 2 billion so that they get a little over 10 million. So my thought is that they needed the money to buy some Oxy because they still, I mean, it's only a small percentage. I mean, Buffett's got $180 billion worth of Apple.
Yeah.
But maybe, I mean, that's 3 months ago. So who knows?
The other announcement, of course, this week from Apple was they're dropping out of the electric car market. They're taking that team and moving them to AI. I personally think that's a good move for Apple. That they need to be more focused on AI. I think their next developer conference, the Worldwide Developer Conference later this year, I think it's in May or June, needs to be focused on AI. We need something coming from Apple. But I don't know. Yeah, I did notice that downgrade at Goldman today, and the stock's down a little bit today, although not nearly as bad as I thought it might be. Still kind of hanging in.
But the market's up, so it's
Yeah.
it's been in a trend this way for a bit. So I did one of my Costanza trades on it, so it's doing really well. So go down. I don't care.
You know what? So I placed a trade today too, and I opened it up. I hadn't seen your trades this week. I did all my research. I saw the downgrade. I opened up to do a Goldman Costanza trade on Apple. And I'm like, oh, you just did one like 2 days ago.
Yeah. So Costanza trade, do it a bear call, a bear credit spread.
Yeah, in fact, we did an
Excellent.
episode on it. Yeah,
you better watch the episode.
Yeah, a couple weeks ago.
So yeah, Apple, lots of opportunity. I had some really good trades this week that I shared with the community. A really pretty awesome one was the Celsius Holdings. Really just incredible. Nice return there. First Solar is another one that I shared with the community. It's done pretty well.
I did an okay trade last week too. On Friday after our episode with Ari, actually.
Oh yeah. Well,
I did a trade on Viking Therapeutics and or Viking Viking Therapeutics. Yeah, they kind of had
the VKTX. Yeah, that was a good call, Greg.
They kind of had a big jump.
Kind of had a good move after our podcast. I think our podcast is that was FDA phase 3 results. There's several others that are, go back and review that. There's some other hot tickets that are worth putting on your watch list there. I had some follow-up with Ari about this, and he was saying, he threw out some other names. He's like, okay, because I said, why didn't you tell me before? I was joking with him because he did tell me before, and we told you. So there's some other ones that's interesting.
Yes, there's opportunity everywhere right now, guys. It's a bullish market. We're in bubble land, but there's a lot of money to be made in bubbles. The bubbles get a bad name because everyone thinks about, oh, we're in a bubble, I got to go short the market. No, trade the bubble. You can make a ton of money if you understand how to trade bullish markets. If you want to be cautious, do conservative risk management type trades. Do the Costanza trade. Do the collar trade.
I'm in a lot of. I mean, I had Apple shares, so I'm collared to the Apple shares. I was looking through the Stock Traders Almanac, and I wanted to show. Yeah, I'm going to show this screen too. So, I do think it's worthwhile to consider to be cautious right now. Part of the reason for that is because do you follow Brent Donnelly?
I do.
Have you seen his magazine cover? Capital he talks about.
Yeah.
So I love Donnelly. It's hilarious. Why am I not signed in? Wrong account. Hold on a second.
Yeah, The Economist.
Yeah, so he's got The Economist, what he calls magazine capital, or magazine cover capital. Where is it? There it is. So you go follow him and read this. But basically, what he does is he's got a virtual account. Maybe it's real money. I don't know. But whatever The Economist puts on the cover, he shorts it, and the average is up to 28% on average. So whatever The Economist says, do the opposite. And it's actually works out pretty good. So The Economist reminds me of the Sports Illustrated curse, right?
We should add the link in the below after the recording to his he's got an article on Spectra Markets, which is his website, where it goes through and explains this whole rabbit hole, the magazine cover indicator, and how he started coming up with it. So maybe if you put the YouTube recording together, here I'll ping it over to you right now.
Yeah, I know we can get him on here too. We should interview him.
We
'Cause
should get Brent on
he's
here.
smart and he is funny. I love, I mean, he's a combination. He's witty. He's fun to be around. He gets it.
Have you ever fished with him? I fished with him last year. That was fun up at Camp Kotok.
You got partnered up with him?
Yeah, we were in the boat one day together. That was a good day.
Spectra Markets is his
Yeah, right there.
website. Yeah, you can find the magazine cover indicator. I can put a link in our YouTube. Um, yeah. What I love, one of the things that I love about going to Camp Kotok is the fact that there's people up there who don't think like other people. We talk about like Jim Bianco and Peter Bookvar, and I mean, there's so many other Barry Ritholtz and Dave Nottig and
Sam Rhines.
Sam Rhines for sure, and then
Yeah.
a whole bunch of chief economists from companies, and then other hedge fund managers and CIOs, and of course David Kotok himself, who's a thought leader. So yeah, lot of fun times up there. And you and I were talking about something interesting about one of the other pastimes that we do while we're there.
Oh yeah.
We talk about playing poker.
And the odds of getting four of a kind.
Yeah, so let me I'm gonna this is an interesting tie-in here. I was thinking about what we are gonna talk about when we're gonna present today. And I just finished reading Annie Duke's Thinking in Bets. So I use this website called Beautiful.ai to create a presentation, Beautiful.ai. And I told Greg, literally took me a minute to do that. So how do I get to full screen? Was that beginning? Preview, whatever. We're not in full screen. Okay, but it literally took me a minute to create. This is the cover of the book, Thinking in Bets. So Annie Duke's a poker player, and the gist of the book is to think about all the possible outcomes and to look at probabilities. And sometimes we don't have data, but we should be able to make estimates of probabilities to make better judgments. And she talks about the importance of focusing on the process, not the outcome. And this is something that I think is really wise. I don't know if you saw this tweet that I shared. If you're not happy with the results, focusing on the results isn't going to change it. You need, if you're not losing, I think about trying to lose weight. If you're just looking at the scale and saying, why am I not losing weight? Like, that doesn't help. It's the process. You need to exercise, you need to sleep, you need to eat well. Though it's the same thing with making money. I mean, you just don't look at your portfolio balance and say, why am I not doing better? And so it is all about process, which is what we teach and promote at both Trader Oasis and Options Animal. And weighing probabilities has a big deal, has a big impact. And thinking like a poker player, you have to focus on the process versus the outcome, and not be into what she calls resulting. I'll get to that in a second. The example I use is Russian roulette of a good outcome, bad process. In the game Russian roulette, you put one bullet in, you pull the trigger, and 5 out of 6 times you win. So is that a good win? The outcome is good, but the process is bad. So you can have bad process. And the example that we were talking about, let me finish this thought, is she says, don't focus on resulting. Resulting is no place in decision making. And that is looking at your results, looking at, hey, you did a win. You placed a stupid bet and you made money. So you focus on the results. And the example that you and I were talking about was when we were playing poker, sitting around the table with the names that we just mentioned. And I had a pretty strong hand. So I forget exactly what I had, but it was better than 3 of a kind. So it's either 3 of a kind or a full house. And we were playing with another guy who's, for Chatham House rules, I won't use his name, but I'm sure he wouldn't mind. This guy's manages a ton of money. He's an investor in farmland. He owns tons and tons of farmland around the US. He calls on a big bet and says, I didn't look at my cards. So on the board, it helps me, right? And then there's some random crap and a two, and go around the table. Eventually, I go all in. So it comes down to me, just me and this other guy. And he says, I still haven't looked at my cards. And showing on the board before we get to the river, there's a pair of twos. I, maybe if he has a two, he's got trips, but I've got a better set. So we're all in and we flip the cards. And you saw this. You remember. What did he have?
I was there. I
What did he have?
He had a pair of twos.
He had a pair of twos.
In
So
his hand.
he had four of a kind. Now, the odds of him having that hand are something like 4,800 to 1, like almost 5,000 to 1 odds that he has four of a kind. And he bet blind. He did the whole thing. He went all in. And I mean, people were screaming, jumping up at the table, like, oh, and I lost a ton of money on that hand. I mean, I lost hundreds of dollars on that hand. But I don't regret it because I would do exactly the same bet again because 4,800 to 1 odds in my favor of having a better hand. That's not exactly it. I mean, he could have had a strong, but I was probably in the 95%. If you were showing those numbers like they show at the, in the casino, when they show the Texas Hold'em tournaments, I was, if I didn't know what his pocket cards were, you would have put your money on me. So this is focusing, I think the key still goes back to not focus on the results and say, oh, hey, I went all in without looking and I won. Let's do that more often. And going back to Russian roulette, people who sell naked options, naked calls, naked puts, you win a lot of the time, but you're taking excessive risk. And
let me share a perfect example of that in a trade that we had already talked about today, Viking Therapeutics. I shared a trade on Trader Oasis. It was a simple covered call. Obviously, it was based on a conversation we had with Ari. I felt like that's a great company. I'm going to place a trade. I wanted to be conservative and covered, so I did a covered call. A lot of people would have looked at the premium in the call option that I was selling and said, why buy the stock? You can get a higher return by just selling that naked call that I did I've still got it in my portfolio. I can look at it right now. It's the 38 strike short call. And the stock was trading at like 32 when I bought her, 33, something like that. My net debit on the trade was like $31. And I'm going to sell at 38. I'm going to make a $7 return on a $31 investment in like 18 days. It's going to be a great return. The stock's at 85 today. It hit as high as 99 a couple days ago. If you had a short naked call at 38 bucks, all of a sudden you're in major trouble. You have a big losing position. And that goes exactly to the point you're taking at. The process of your decision-making in your trades is important to always ask the question, what if I'm wrong? I may be doing a trade with high probability and it's going to give me a really high return, but what if I'm wrong? Can I survive if I'm wrong? Because in the game of trading, that's really the most important thing, is how long can I keep my capital and keep it working for me? Because there's going to be times when the market's irrational. There's going to be times when the market's explosively bullish or horribly bearish. And if I don't understand my risk position in every single trade I'm doing, whether it's a covered call, whether it's a collar trade, whether it's a credit spread like an iron condor, I know a lot of people in the world like to pitch this idea of there's free money out there to go sell credit spreads or sell naked options on the outsides of the indexes, and do these high risk, high probability returns or types of trades, and they pitch it as a no-brainer type of return. But can you survive if you're wrong? Because I've seen way too many organizations, big organizations, go belly up because they didn't understand the risk management.
Well, we talk about that. There's a book on Amazon that still gets reviews today on, it's literally called The Guide to Selling Options. It's the 3rd edition. And the founder of that company went belly up and lost hundreds of thousands of dollars for his clients. And we happen to know people who were associated with that and lost millions of dollars. And the lessons don't get learned out there. To me, it's equivalent to playing Russian roulette. I couldn't let a friend do that. Just because you look at a stock chart like, or I'm sorry, yeah, look at like Viking Therapeutics, and you're going to sell a call, naked call or something like that here. So, well, look back over the history, the stocks never made a move like that before. Like, but what stocks do move like that. And you see it in big names. You'll see Apple occasionally. I've seen a 10 sigma move in Apple. And if you're on the wrong side of it, it's a freight train. And believe me, 10 sigma moves are that's like when the earth was still in one continent. Pangea was still
Pangea.
Yes, and Pangea still existed. And if you look at it should happen in like couple 100,000 or a million years. We haven't had a stock market that long. 10 sigma movements. If you bring up a 10 sigma movement, people tell you're stupid. It's like the order of the universe sort of thing. If you talk about it, if anything about 3 or 4 sigma, and what that means is that the models are wrong. So they break down on the edges. People who do these, I don't think they understand risk. And the analogy I use is turkeys on a turkey farm. Is you get great health care, you get a nice place to live, you get good shelter, you get protection from predators, you get food, water. You don't have to worry about too much. Life is really good on a turkey farm until October. Then things change. So just this is the point is don't focus on the outcomes. Don't be resulting. It's like hey, I did it and it worked, so it must be good. And that is a common heuristic bias, but it's the reason why the people who did stupid stuff like that heard noises in the grass and said, hey, this looks like something's moving over there. I'm going to run. It could be the wind, but it could be something furry with flat fangs and teeth. And our ancestors who ran when they heard noises, that's who we came from. So these biases still affect us and they don't serve us well in investing. So the key we preach is focusing on a good process that has a sound background, that you can look at probabilities and you can look at the process and say, I understand how this works. But sometimes you're going to have bad outcomes. And that just happens. Sometimes the low probability thing happens. That doesn't mean the odds were wrong. I mean, you can flip 12, can I flip heads 10 times in a row? Yeah, the odds are like 0.01%, but yes, you can do it. Or can you roll 12? Heck, we've seen people do it 3 times in a row at a craps table, right?
Yeah.
Or 11.
Yeah.
Yo, roll. Anyways, the point I think of this book, it's a great book. Although I honestly think it could be a pamphlet because I'm pretty much telling you everything you need to know right now. You got to identify your options, gather the evidence, weigh the probabilities, and commit to your best practices. So it's focus on process over the results. It's going to make you a better trader. So you map out what probabilities and then consider all your evidence to weigh your probabilities as best you can and be willing to change your mind when the data changes. So this literally took a minute for me to create using AI, which is another reason why in the beginning I talked about AI being game changing. Beautiful AI, you can go do this for free. It literally took me, I'm not an iota of an exaggeration. Okay, 2 minutes, 2 minutes, less than 2 minutes to create this beautiful presentation with images and words and everything. And pretty close to being perfect.
Cool. Love it. So between now and our next one, our next episode, we already have scheduled. It's going to be with Charan. You mentioned that Charan Singh next week, but maybe our next one after that, you and I need to have a one-off and talk about, I need to ring some non-Chatham House conversation that you've had with this
yeah, we need to debrief
you went to in the Bahamas. So we can do a download.
That conference was really good. Yeah, I can share it's very fortunate to be there. Leland Miller was there. Great feedback from Leland. Of course, David and I got really, he specifically sat me next to him at dinner. I mean, this is a Kotak thing, and there are 25 people at dinner, and he specifically wanted to sit next to me, and we talked a lot about gamma and other stuff. So really
Cool.
good conversations. Sorry you couldn't make it.
But
One other thing we should talk about, and that is Las Vegas and our summit, which is locked in. For those of you that are members of Options Animal or Trader Oasis, this is an absolutely priceless. I shouldn't say priceless. It's worth 20, I would say $2,500. If you were going to go to an event, and I've paid money to attend live events where they do, training and trading, and we work really hard to bring special content to you in a format that you're not going to find online. One-on-one live. We're going to have some amazing presentations here. And it's at the Strip in Las Vegas. So go to the Options Animal website and sign up. If you're not a member, call and talk to them and say, hey, listen, I'm interested in going to this event. I'm telling you, you would pay $2,500 and walk away satisfied, but you can attend for free if you're interested.
yeah, just get a hold of us. We'd love to see you there. And it's again April 12th and 13th in Vegas. So looking forward to that one too.
All right. Well, 45 minutes left to trade. I got to go.
Okay. We'll talk to you
Really
later.
good content. Well, this
We're
and
doing
like
the
I always
weekend.
like, what are we going to talk about? But you and I always have some interesting things to talk about.
Yeah. Thanks, Eric.
See you later, buddy.